So my name's Sean Michael Walker. I'm the Vice President of Premier Group Insurance. I do this presentation frequently enough that we wanted to finally record it. I do this presentation and talk about the insurance spectrum, the spectrum of insurance, and how it plays out and why carriers do what they do frequently enough that I want to get this recorded so that we can have this for you. So some of the things that we're going to learn today in this presentation, the insurance spectrum, some of the things that you'll be able to take away as a result of watching this video about the insurance spectrum is why and how companies expand within the insurance spectrum, why they target specific segments within the insurance spectrum. Hopefully you'll be able to see this in the video. Common terms they use within the insurance industry and how those variables affect the carrier's decisions. How insurance companies make money and how that's a result of their desire to expand or retreat within the insurance spectrum. We'll also identify factors that contribute to their desire to grow or shrink within their appetite to either own more of the insurance spectrum or less of the insurance spectrum. We'll review common tactics that they use to control their flow of business and profitability within their specific appetite of the insurance spectrum, and we'll talk about why this all matters to you as the agent. Okay, so to everybody in the room right now, I want you to clearly see that this is a spectrum, right? This is one end cap, and this is another end cap of the insurance spectrum. We're going to refer to this as just personal lines, okay? If we were to jump into this conversation from a commercial lines perspective, it would be all different carrier names on this board. But this end of the insurance spectrum is preferred. This end of the insurance spectrum is non-standard. Let me explain to you what a preferred risk looks like. A preferred risk is probably a multimillionaire, right? It's somebody who cares about insurance. It's somebody who has multiple properties. Those properties are full of hallways full of art. Those properties are full of safes full of gold and silver. Those properties have lots of guns in them or lots of valuable things within them. They're usually business owners, so they need to insure their businesses as well. They've got 3 or 4 really nice cars, 4 or 5, 6 or 7 really nice cars. They have the Ferrari in the parking lot or in the driveway, right? They have the really nice houses and things within the insurance industry. They very much care about the things that they're insuring, right? So they have the toys, they have the boats, they have the motorcycles, they have the ATVs, they have a whole bunch of things that need insured, right? You got me? This other end of the spectrum is the non-standard end of the spectrum. Imagine the guy who is going into the DMV tomorrow and is going, I don't care about insurance, I don't care about insuring the thing that I need to have legally insured, but tomorrow when I go to the DMV, I have to prove to somebody that I had insurance that day so that I could get insurance. That's that person, right? That's the person who goes, I don't care about insurance. It's the law that I have insurance. So all I care about is fulfilling my duty to the law. And for the duration of how long I actually have that insurance, maybe it doesn't last that long. So within this spectrum, you have things that fall all up and down this spectrum. So if this is the multimillionaire, that owns a bunch of properties and has a bunch of rental properties that need to be insured and whatnot. Maybe as we slide down the insurance spectrum, we're just talking about really nice suburbia, right? Or really nice property, the person who owns the $250,000 home. And as we slide further down the spectrum, maybe we're talking about those properties that you drive by and you go, oh, what an ugly house. That house is not upkept well at all. It's really not that nice of a house. I wonder who owns that and who insures that thing, and it's really not that nice. And as you get down to other parts of the spectrum, you get into maybe just monoline auto, right? They don't own a property, but they own a really nice car, right? They own a really nice car, but they rent something. And so they don't need to insure a property, but they do need to insure their really nice, $80,000 car. And as we slide down the spectrum, you start leaving property ownership and you start sliding into just auto-only ownership. And then, of course, there are people that own autos that that aren't $60,000, $70,000, $40,000 autos. Now we get into the guy who got the tax return yesterday and he's got $8,000 in cash. He needs a new car, so he goes and buys an $8,000 cash car, right? Perfectly fine, great people, but they have an insurance need and they go insure that $8,000 vehicle, maybe full coverage, maybe liability. But as we slide all the way down to the end of the spectrum, maybe we're just talking about that person who's driving that 1982 Honda Corolla, and it's the car that makes noise and spits out the gas and fumes as you go down that, and that person might not have a lot of need for insurance, right? So that's the spectrum of insurance. As we get into the spectrum of insurance, it's important to note that every single insurance company owns sections of the insurance spectrum. So you can see here, Nationwide takes up a portion of the insurance spectrum, and Allstate and MetLife and Esurance and Farmers and Allstate and Safeco and Liberty Mutual and Amica and Chubb, they all own different percentages of the insurance spectrum. And it's important to note that every single insurance carrier has a part of the insurance spectrum that they want to do business in and parts of the insurance spectrum that they're more than willing to ignore. Now, it's important to note that not one end of the insurance spectrum is better than the other. Insurance agents can make money at this end of the insurance spectrum, and insurance agents can make money at this end of the insurance spectrum. It is important to note, however, that this person at this very end cap pays their bills very differently than this person, right? This person might say, just put me on EFT, just tell me how much it is, I really don't care, don't talk to me about insurance, right? And then this person might come in every single month with cash and say, I want to pay my insurance policy in cash because I just got paid, and I want to make sure this happens. This policy will retain for decades. You'll write the policy once. The file will stay this thin, except for when you're changing one Ferrari out for another Ferrari. And this policy might change frequently, right? Because that $5,000 vehicle broke down and I got to change my vehicle, and oh, my policy canceled because I couldn't make my payment, and so I need a new policy, and so this client might be more work than this client, but that's a hasty generalization. It's not necessarily these clients are less work than those clients, okay? So every carrier has a part of the insurance spectrum that they want to own. And within that insurance spectrum, they might say, we want to write suburbia all day long, every day. We want to write beautiful suburbia all day long, every day. Some carriers, like Chubb, say, we want to write, I don't know, I'm not quoting Chubb by any means, but we want to write the top 1% of America, right? We want to write the famous people who are worth millions of dollars, who own millions of dollars worth of stuff, and we want to insure those people, right? And they specialize in that very specialized niche. There are companies that specialize in this very specialized niche and want to insure the person who has 3 DUIs and thinks that they can make money insuring that person, and quite frankly, they do, okay? So we have a bunch of different insurance companies owning a bunch of different parts of the insurance spectrum. It's important to note that insurance is sold in 3 different ways in the United States, right? It's sold by independent insurance agents and independent insurance agency brands, right? Liberty Mutual, Safeco, MetLife, Auto Owners, Travelers, Nationwide, Foremost, American Modern, and on and on and on. There's hundreds of them. Direct carriers. Direct carriers are like Allstate, State Farm, Farmers, right? They are, that would be a captive carrier, I'm sorry. But a captive carrier like Allstate, State Farm, Farmers would sell with captive agencies. And then, of course, direct, which would be like direct to consumer, like Geico, right? You see a bunch of commercials. You see enough commercials that finally you call their phone number and you actually choose to do business with them. Esurance would be another example of direct to consumer, right? So you see enough commercials with Jim's voice from The Office, and you go, wow, that's a really nice voice. I think I'm going to finally call Esurance and see what they do for me, okay? So these are the 3 different ways in which insurance is distributed within the United States. Now, all of those different companies, again, decide and choose how much of the insurance spectrum they want to, how much they want to specialize in. So it's important that we now talk about the fact that carriers expand and retract within the insurance spectrum and what they do to expand and retract within the insurance spectrum. So we'll use an example of, we'll use the example of Progressive because they're right here in the middle, and I haven't talked about Progressive yet. Progressive historically has owned a very big part of the insurance spectrum. Despite the fact that they used to be a monoline auto company, they used to write monoline auto, and still do write monoline auto incredibly well. So they could write all the way down, all those people that get DUIs and have this really long driving record, they could do that incredibly well. And they could also write all those really nice autos that are worth $50,000, $60,000, $70,000, $80,000 on the road and still write all of those. So they could write autos incredibly well. Well, Progressive just did something that paints the picture perfectly of what I'm trying to illustrate, and that is they expanded within the insurance spectrum by buying a company called ASI. ASI is now called Progressive Home, but they've ultimately said we could only go so far up this insurance spectrum without getting into this market share. And now we can get into this market share and compete against State Farm, Farmers, Allstate, and all of these different brands because we bought ourselves a property company that allows us to go in and compete for this market share within this end of the insurance spectrum. So every single company does things to expand and to retreat within the insurance spectrum. Now, there's some things that are really important that you guys understand from that perspective. Sometimes carriers want more market share, sometimes carriers want less market share, and I want to explain why. So we need to understand how insurance companies make money, okay? We must understand how insurance companies make money. Insurance companies make money in two different ways. One way is an underwriting profit. An underwriting profit means for the product that they sell, they make money off of the product that they sell. So when they insure you for $1,000 of auto insurance for 6 months, they know or they hope that they can make money off of that $1,000 that they sell you. So they go, maybe you'll have a fender bender, but ultimately, if you have a fender bender, hopefully that fender bender only costs $700 and we make $300 off of you as the insured. Okay, so that's the underwriting profit. We collect money for the product, the insurance product that we sell you, and hopefully you don't use all of that money in a claim so that we can actually make a profit. Okay, the other one is investments. Investments in the stock market, right? So I think Progressive is saying this year alone they're going to grow $6 billion in written premium. I'll use Progressive again as an example. If the stock market is good and Progressive collects $6 billion from every single insured across the United States and takes that $6 billion to the stock market, then if the stock market's good right now, then they can make, what does the stock market typically return? I think it's, historically speaking, it's like 10%, right? So they run over to the stock market with their new $6 billion and they say, well, while we're waiting to pay out these claims, we're going to make 10% off of this $6 billion. So while I'm waiting to give you your $1,000 back that you gave us to cover your future claim, they're saying, I'm going to take your $1,000 over to the stock market and make 10% on that $1,000, which is $100, right? So they go, you know, we really don't care if we have to give you back your $1,000, right? What we do care is that we're making our money anyway in the stock market. So if the stock market's good, I can take your $1,000 and say, give me your $1,000, I'll give it back to you later. I don't even care if I have to give you every single penny back, as long as I know that I can run to the stock market and make my 10% there. So I'll just make my profit off of the investment versus the actual product that I sold you, okay? Now, what happens if the stock market's bad? If the stock market's bad, then the insurance company can't take their $6 billion over to the stock market and bank on a 10% return on investment. And so they go, we can't take it over there to make the money. We used to, a lot of companies would actually run a 100% combined operating ratio. And a combined operating ratio is loss ratio plus expenses. So what insurance companies used to do is, or what insurance companies do when investments are good in the stock market is they go, we don't need to make a dime off of the actual underwriting profit because we know that we'll make a dime off of the investments. So let's just play this out. The combined operating ratio is losses plus expenses. So let's use that $1,000 for your auto insurance, right? You give me $1,000. I go to the stock market and make $100 off of the investment. Do I care if I have to give you your $1,000 back? No. So I could get zero profit off of the underwriting profit, and I know I get 10% profit off of the investments, and so I don't care that my combined operating ratio is actually 100%. Right? If I lose 100% of your written premium because I have to give it back to you for a claim, then I'm okay with that because I made money somewhere else, right? So combined operating ratio is loss ratio. Loss ratio is losses divided by earned premium. So of that $1,000, how much of it did I have to give back, right? If I have to give all 1,000 back, the loss ratio is 100%, okay? If I have to give back, let's say 60% of it, $600 of the $1,000, then I still have to worry about the expense ratio. The insurance company still has to say, well, we still have to pay all of our claims adjusters and all of our underwriters and do all of our technology and cover all of the expenses of running an insurance company. So you take the loss ratio plus the expenses, gets you to a combined operating ratio, and that combined operating ratio, companies care about their combined operating ratio all the time, of course, but when there is investment money to be made in the stock market, some companies might say, you know what? Let's run a 102 combined operating ratio. Let's lose 2 cents on every dollar because we know that we're going to go get our 10% somewhere else. So let's own as much of this insurance spectrum as we can possibly own. Or let's expand our appetite so that we can get as much business as we can get, because it really doesn't matter if we make a profit on that business or not, because we're going to get the money back a different way than actually on the product that we're selling. Does that make sense? Good. So now it's important to note that sometimes the stock market's not a really great place to be, right? What happened in 2008? In 2008, the stock market went boom. Everybody said, oh, we're not making money in the stock market. So every single insurance company came to every single insurance agency's door and said, so turns out we're not making money here anymore. And so we now need to make money here. So historically speaking, we were okay with having a lot of this insurance spectrum and running a little loose so that we could get as many policies as we get, because as many policies as we can get means we get a lot of $1,000 hits here and $1,000 hits there. But it turns out we're not going to make money in the investment income. We're going to make money now. We have to make money now on the actual product, which means we can't run 100% combined operating ratio anymore, because we now need to make money on the product that we actually sell, okay? So then what an insurance company does is says, okay, historically we used to write people with 3 or 4 tickets or accidents, and we can't do that anymore. We opened that up intentionally so that we could make money, so that we could get the policies and get the written premium and make the money in investments, but now we're not doing that anymore. We can't do that anymore. So we can't keep writing people with tickets and accidents. On this end of the spectrum, you might see Allstate or Farmers or State Farm say, we don't like teenage drivers as much as we used to like teenage drivers because they get into accidents, right? Or you might see insurance companies saying, we need to do things to shrink our appetite now that we have to make our money on our underwriting profit, okay? So there's a lot of ways in which insurance companies do that. I just want to point out some here. So these are some ways in which they expand and deflate their appetite on the insurance spectrum. So you could say at this end of the insurance spectrum, an insurance company here in middle America, suburbia, might say, as an insurance company, we're only going to write houses up to $500,000, right? But when times are good, they might say, actually, times are fine right now. We need to get a lot more business on the books so we can make this investment income. So we're actually going to write homes up to $1.2 million. And then when times are bad, they might go, it's bad right now, so we need to shrink that down to $500,000 again, okay? Change in advertising and spend, right? So an insurance company might say, a lot of our expense ratio was spent advertising 15 minutes less could save you 15 minutes or more, right? These guys used to be the largest advertiser spender in the industry. I think in 2018, they stopped being the largest advertiser in the insurance industry because expense ratio, return on investments, the actual underwriting profit, which we'll talk about in a second. A lot of carriers took a hit on the underwriting profit because of some things that happened, and we'll talk about that in a second. So changing your advertising budget or changing your expense ratio by doing that. Changing your wind-hail deductible. So a lot of insurance companies might say, we're writing a lot of business, we got way too competitive, we're writing a lot of business. And they might say, okay, well, let's change our wind-hail deductible. Let's change, if everybody in the industry is selling a $1,000 wind-hail deductible and you change your wind-hail deductible to be $12,000, what are the insurance agents going to do? They're going to protect their clients probably and say, hey client, you know, we have hailstorms frequently here in Colorado or in Texas or somewhere in the United States. Because we have those hailstorms frequently, I want to sell you a policy that has a $1,000 wind-hail deductible, so next time it hails next summer, you only have to pay $1,000 versus a $12,000 deductible. Well, that insurance company might intentionally be doing this, right? Shrinking their market share. Insurance companies take rate increases or rate decreases. You take a rate increase, right? And maybe you shrink your appetite within the insurance spectrum. You take rate decreases, maybe you open up your appetite. Accept teenagers, I already mentioned that one. Accept more driving activity. So the further down the spectrum that you go, the more you go, hey, you know what? We used to be comfortable with one DUI, now we're comfortable with as many DUIs as you got, right? Maybe you say times are not good in the stock market, and we need to make an underwriting profit, so we're going to tighten that up. Another way they do that is submit pictures. So they make the field underwriting difficult for the agent. So a lot of times in California, if they can't get what they need in California, maybe an insurance company says, we need to control the flow of our business better. We want to limit how much of this spectrum we're doing or how much business we're getting from the part of the spectrum that we've decided to target. So what they say is, you know, insurance agent, I'm going to need you can still submit business to us, that's perfectly fine, but I'm going to need you to submit pictures of all four sides of the vehicle. And so the agent's going, I'm not going to go out and take pictures of all four sides of the vehicle. Maybe an insurance company says, I want pictures of all five sides of the vehicle. So all five sides and then the top. I want a picture of the roof too. And the agent's going, I'm not going to buy a ladder to take pictures of the roof of the car just because you want that done from an underwriting perspective. The insurance company's saying, well, that's okay with me because we don't want that much business right now. We're struggling to have a underwriting profit.